Hey everyone, welcome back to GTech Finance. So the Federal Reserve just spoke with Jerome Powell, the leader of the Feds. And so what we've seen from it is basically the market crashed again. That V-shaped crash we had this morning, basically we got revisited in certain stocks like Tesla. Not in all stocks, but we didn't hit, we saw stocks like Tesla hitting rock bottoms. It went to around $606. So we didn't hit the sharp bottoms that we did this morning, but we definitely hit some lows after Mr. Powell decided to talk today. Why would this happen? Well, the easiest thing to do is explain what Jerome Powell said, add some insight into what Jerome Powell was saying, and then go into what he didn't say, which is causing some pain in the market. So here we go. First, Jerome Powell started off by talking about inflation, and this is a big thing. Jerome Powell drills this into the market, but the market doesn't care. Jerome Powell consistently tells us that it is unlikely that, quote, deeply ingrained inflation expectations will change. What this means is we have had inflation declining in America for decades since the 80s. Inflation has been going down. We expect things to get cheaper with technology, not more expensive. In time, we have been in this deflationary cycle, much like the Eurozone, which is even worse off than we are. And Jerome Powell believes, look, we're going to see these short-term spikes, and there are two reasons we're going to see short-term spikes. One, we're going to see them because of something called base effects. In English, that means in March, when we look at the inflation readings, the CPI readings in March, they're going to be way higher than they were in March of last year because inflation was in the toilet. Last year, everybody's cutting prices because nobody was buying anything, right? We had this sudden deflation March, April, and May of last year because of the pandemic. And so when we compare year over year, it's going to look like, oh my gosh, we've got 3% inflation, 3.5%, and plain percent inflation. Jerome's like, dude, that's not going to matter. Like, that is not real inflation. That doesn't matter. So ignore that. He's making this crystal clear. He says the same thing over and over again. He's basically begging the market, like trying to grab people by the next coin. We're not seeing inflation again. Just stick it to your mind. Price it in. And he's keeping money printing, grabbing your neck. No inflation. Okay, while running the money printer like crazy. We all know this meme. But who doesn't believe he's running the money printer right now? Jerome Powell says that there's a second reason we could see inflation, and that's just the economy reopening again. People go on vacations again, traveling again, spending money again. That'll create short-term spike in inflation. But the big thing that he says here is it is unlikely that, and he really added, inflation today is deeply ingrained. Inflation expectations will change. Jerome Powell believes that inflation only goes up when people expect prices to go up. So for example, let's say a cup of coffee is $1. We expect this cup of coffee will be $1, $1.03 next year, then $1.06, thereafter $1.09, and maybe it goes on. Then we expect inflation to come, but most of us don't expect it. We actually expect the cup of coffee to maybe go like $1 or maybe $1.02, right? We don't. Society tend to believe that there's going to be massive inflation. However, the money printing is what's creating this bizarre thing. Like, if you ask people, a few years ago, when are we going to see big inflation? Most inflation wasn't that big of a concern. Inflation really only became a big concern because of the money printing that's happening now. And it's possible that Jerome is wrong, and that's the bet the market is making. The market is betting money that Jerome Powell is wrong. The velocity of money is going to go up. The amount of time money circulates through the economy is going to increase, which means prices will go up because so much money is going to be chasing a limited supply of goods. Supply demand says then prices go up. Jerome is saying, okay, fine, maybe that'll happen after reopening. Demand's going to go up massively. There's not enough supply. That's not going to stay consistent. We're not consistently going to see those pressures. And so when he's asked, is the market wrong on inflation? He says, look, we're watching the bond market. We saw what happened in the bond market last week, basically the spike of the 10-year to 1.5, that acceleration, and the bond yields going up. He noticed that. He says he paid attention to that. But he says, look, despite what happened, we're a long way from our goals. We would be concerned if the markets were actually starting to fail, or if there were a tightening of financial conditions, that banks like oh, we don't want to lend anymore, let's start freezing credit lines and stuff. He says that's when I would be concerned. But markets say, think rates are going to go up sooner. We don't think so, is what Fed Chair Jerome Powell is saying, and I'll explain why. Then the market is crashing because there's a reason for that. Then he says, what would it take to then raise rates? And he says, look, it's going to take substantial progress for some time. When he uses the word sometime, usually he's referring, in my opinion, to 6 to 18 months of progress. In fact, he kind of laughed about the fact that, I mean, he didn't laugh about it, but that's not laughable. But he's kind of like, look, we just had 3 months of no progress, is what he's saying in the labor market. Like, we need substantial progress for some time. And we just had 3 months of no progress, like Jerome Powell. Like, if you could really simplify what Jerome Powell feels right now, he's kind of, how effing clear can I make it? We're not having any progress. Why are we assuming there's progress? There has been no progress. And when you see no progress, we think the progress we think is going to come is going to be temporary, and feeling like Jerome Powell on the inside is like, he's freaking out. He goes home to his wife and he's like, these people don't get it. I keep saying there's not going to be inflation, but yet they think it's going to be, we're close to a recovery. And market thinking, no, Jerome's lying. The rates are going to go up soon. I think that's in his head. Essentially, there he goes home and he's extremely frustrated. And that's why when he's on these interviews, he said things like, we're trying to get to sustain 2% inflation and run moderately above that. We're trying to get the maximum employment, which maximum employment doesn't just mean 4% unemployment at a rate like it happened with Donald Trump. It means that blacks, whites, Hispanics, women, Latinos, people of all races and colors are fully employed. That's maximum employment. And that's very important. He says we are, quote, a very long way away from that. And there's a lot of recovery that still needs to happen. We're not going to raise rates until we see these conditions fulfilled. And he calls these conditions very desirable. AKA, it's like he's going, dude, it's a long way out. He says inflation expectations are expected to be transitory, and he even gets frustrated during the interview. He says there's a lot of ground to cover. I'm trying to make it as clear as possible. The problem is Jerome Powell is stuck with all the big words, and he just needs to simplify and go, y'all, look, it's simple. We ain't got inflation right now. Solid inflation coming for probably 4 years from now, so just shut the F up, sit down, keep buying your stocks. We're going to keep running the money printer and stop freaking out, because you're freaking out for no reason now. Whether we believe him or not, that's the different thing. Clearly, the market doesn't believe him. So I'm going to talk in just a moment about why would the market go down while he was talking. But I quickly want to finish, make sure I got everything. Presumably, the next couple of months, we see some growth. We'll want substantial further progress. So he's already discounting the fact that we're going to see some growth in the next few months. And he's basically saying, like, I'm going to take some time beyond that to actually see growth, in terms of when he doesn't speculate on that. There's no formula for it. It's just really whenever Jerome Powell feels like we've hit substantial growth. There's no steadfast formula. I think that's why people are frustrated, because it's like confusing. Because again, he's holding you by the neck, choking you, going, there's no inflation, but he's running the money printer and billions of dollars of spewing into the economy every month. So it's like mixed messages. People have a hard time believing what he says, but he's conceding his emotion. But he's really frustrated inside. So why would the market sell off? Why? He's thought while he's talking, not all stocks sold off, but the lows we saw earlier, with the exception of Tesla literally just right now looks like it hit a new low. I just want to buy Tesla stock right now, and as always, I send alerts of all my buys. So, as always, he's basically saying all the right things. So why would the market sell off? Okay, here's the answer. The market is selling off after Jerome Powell spoke, because the market expected. There were rumors circulating about this last night, a lot of rumors about this last night. There were rumors that Jerome Powell and the Fed were going to come out this morning before the pre-market, or potentially during his talk just now. And he was going to come out and go, what we see, stress in bond market, we're going to extend the standard liquidity ratio at banks, which expires on March 31st. And that is going to, in English, we're going to make it so that banks have more cash available. and they can go buy bonds, which if they buy bonds, that'll drive the yields down. Jerome did not do that. That is why Jerome crashed the market today, because Jerome doubled down on his old talk, which we already know about, but did not do what the market was expecting. This deadline is coming up on March 31st. It's called the SLR, Standard Liquidity Ratio, something like that. Basically, it says banks need to keep a certain percentage of cash on their books, but that was eliminated during the pandemic for 1 year. It was kind of like March, in March they eliminated this liquidity reserves ratio, then they extended it, and this was going for last for a year. The expiration comes up at the end of the month. There's a rumor that the reason bond yields are going up is because banks aren't able to buy, because they're trying to come up with enough money to make sure they can meet the rules that are coming around at the end of the month. Now, banks haven't really been massive buyers of bonds, so I don't know. I think they're like 5% buyers of bonds or whatever, so I don't know. So I think that's it for today. If you enjoyed the video, hit the like button, subscribe to the channel if you haven't already. And by the way, I wanted to add something. The last video achieved 55 views. It's absolutely massive, and I only have you, my audience, to thank. It's really awesome, and hopefully the other videos ahead are gonna do just as well, and hope to see you guys next time.